Hey everybody, Boris. Welcome to the commodity dollar update for July 25, 29, 2016. Odd, CAD, Kiwi all got crushed a little bit this week, and the story has been, of course, that first of all, on the Kiwi side, a very concerted central bank attempt to just guide the currency down by not even threatening, but promising to crumble and cut rates. And that's really the story with the calm dollar, especially with the Aussie and the Kiwi, the high yield or calm dollars. It really becomes a battle or a game of chicken as to who's going to cut rates, when, and how. Now, the one thing I will say about trading the calm dollars is that, or just trading in general, is that you rarely want to be on the opposite side of the central bank. As a matter of fact, the rule of thumb in Forex trading is to always be on the right side of the central bank if you want to make money. So the fact that the RBNZ has now essentially promised to cut rates, and perhaps cut rates not even just once, but maybe several times, really suggests that every rally in the Kiwi becomes a sell. And the bigger problem, of course, with the Kiwi is that the ranges have gotten so large that the only way you know you're going to be wrong is some very significant stops, much larger stops than I think most people would be very comfortable with. We'll take a look at the charts as to how you have to kind of trade it. But I still think that ultimately the easiest trade in the world right now is to sell any rally in the Kiwi, simply because the central bank is on that side of the trade, and you want to align yourself with that move. And there is still further, of course, downside action for us to take. Although we've taken 300 points off the top in the Kiwi, so certainly a lot of that number has been already relatively priced in. The interesting thing with the Aussie is that there's been a threat but no promise, and I think that's really the most fascinating part here, is that while the RBA continues to argue that yes, it needs accommodation, that inflation is low, blah, 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 so on and so forth, that they're sort of giving a covert suggestion that August will be a cut date in the Australian data. The actual data out of Australia has not been horrible by any stretch of imagination. In fact, it's been relatively robust. There's really, if you were to simply just look at the economic data instead of the global geopolitical landscape amongst which all these central banks find themselves, I think there'd be very little reason to think that the RBA would cut. But remember that both of these central banks are really operating in an environment where they're the only ones that actually even have a yield, and where everybody else is actually running the other way. And the Fed is not really accommodating them by suggesting that they're going to tighten rates anytime soon. So the carry trade flows, which have just run into the Aussie and run into the Kiwi, have really driven their exchange rates up, and they're not comfortable with that. And they're basically using, I think, interest rate policy as an excuse to move exchange rate policy to the downside. The one absolutely critical release this week is going to be the Australian CPI data coming out on July 27. And that's going to be a big tell. If CPI comes in cold, if it's running well below, I think it's let me see what it's. I think the anticipation is 0.4%. Let me just double check this on my calendar. Yeah, it's 0.4%, which is actually 1.2% on a quarter-to-quarter, a year-on-year basis, 0.4 on a quarter-to-quarter basis. Now, if that comes in soft, that will allow the central bank to cut rates. In other words, if we come in like 1% on a year-to-year basis, that certainly is going to offer a green light, and the market is going to position themselves towards pushing the Aussie lower. If it comes in hot, it really, I think, hampers a lot of the RBA flexibility in some way. So it'd be interesting to watch, and I think Aussie will be in many ways the bellwether calm dollar this week to watch, especially around that 74, 75 level that we're going to be looking at the charts. Dollar CAD still remains so much an oil story. Now, what's interesting about oil is that we've slipped at the end of the week, and it looks to be, and this is I think a very interesting point. It looks to be that the oil market could actually drift itself back down towards the 40. Remember, dollar CAD had a nice big decline, Canadian dollar had a nice big run because oil had popped all the way to 50. But if we start drifting back down to 40, 40 is that Maginot line between being able to survive in the oil business and kind of being on the edge of bankruptcy for most of these companies. So we start drifting towards the 40. Expect dollar CAD to really take out that 132 level resist. I've been bullish on dollar CAD all the way through, as you know. I've been saying it's a buy to dip, buy to dip, buy to dip story, and it's been challenging in the short term, but it's been incredibly correct in the long run. I mean, I've been proven right continuously. We'll take a look at the charts. This has been one of those stealth rallies that's kind of very difficult to hold on to while in the midst of it, because there's so much intraday volatility. But ultimately, it keeps creeping up, and we're going to be looking at the 132s very carefully now as key levels. So let's just take a look at the levels before we take a look at the charts here and see how they shape up for this week. So yeah, one of the interesting things about the COM dollars is that technically the resistance support levels are actually quite wide now, because we've come off the highs, and realistically those highs still remain the absolute key resistance levels to the fresh support. So the Aussie now, the resistance is 77 to the 74 support. A dollar CAD, the resistance, this is really going to be a very key resistance. It's 132. We bust out through this level. I think it's going to be a nice breakout for dollar CAD. And Kiwi, very wide range now, because we got pounded this whole week off of the RBNZ dovishness, and now coming down to a very key support level of the 69 as the week progresses. Let's just take a look at the charts here, and I'll show you exactly what I mean. So first, let's start with the Aussie. So Aussie still remains, if you look at this on a longer term basis, still remains in a continuous uptrend, but we're getting very close to kind of breaking the diagonal trend line right over here. And certainly 74 is the most immediate support, and then ultimately after that, the real big support is 73s. If we get pushed all the way down to 73s, I'd certainly want to be a buyer here for a pop in front of it. If it kind of holds around 74s and turns back up, it actually looks to be a relatively decent trade back up to the upside for not necessarily the full 300-400 points that we have all the way to the upside, but perhaps just a sort of a continuation of the slow but steady uptrend. Again, the slow and steady uptrend is basically a bet on the fact that rates will not be cut. This keeps the Aussie the most attractive carry trade in the world, and therefore keeps the buyers coming back into it. That's really what the technicals are telling us. So you kind of have to trade it off this move. As I said, if CPI comes in very soft and kind of slashes the prices here and pushes us through below the 74s towards the 73s, then at that point it destroys the whole upside structure, and it creates an opportunity here to sell against the 75 top. 75 then becomes the resist point, and you're looking essentially for a full unwind all the way out to 73s on a tactical basis. So for time being, Aussie dollar still remains a very tenuous but consistent uptrend. But midweek, if we break that 74 lows, if we break it to the downside, then it becomes, I think, a sell the rally kind of a trade against the 75 resist. Dollar CAD has been a fascinating move, and this is what I'm talking about. Where ever since I started talking to you guys from the beginning of June, I've been saying this is my favorite long trade because it's just the clearest uptrend, meaning you buy the dip here every time it comes in, because it keeps making higher lows, higher lows, higher lows, and that's a classic sign of a long-term uptrend. What's interesting now is that we've come to to the place where the rubber hits the road, as we say in America, where you put up or shut up at this 132 level, and this, I think, this is really a function of oil. So it's not much we can do in terms of trying to prognosticate what happens on the Canadian economy or anything else at this point. The flows here are going to be very much dictated by oil. If oil starts to slip towards the 40, I think we bust out above the 132s. Certainly, I think if you're watching oil on a relative basis and it starts to come down, this offers a very, very interesting sell of Canadian dollar, not just against the dollar, but on a relative basis against the other comp dollars and everything else. So still, this 132 is the key breakout level. If we take out the 132, then it really becomes a continuous buy to dip story, even stronger than before, all the way down to 130s as the move then posits us to a potential move towards the 135 top here. And then last but not least, excuse me, Kiwi Dollar. And the Kiwi Dollar, of course, got crunched by the dovish RBNZ, but now we've come to that. Remember we talked about that 70 was a key support level, and indeed it was. I mean, now we broke all the way down to 69.50 in the aftermath of the RBNZ decision, but we came right back up. And that's, when we talk about support resistance levels, I think it's very, very important to understand that it's a zone. It's a zone. When you're trading technically, there's no such thing as precision in technicals. There's only just zones. And the relative zone, I think that whenever you looking at the round number, I think the good rule of thumb for anybody who's trading technically is to think of it as a sort of a 50 pip, a half a penny rule of thumb. Sort of, it's 70 all the way down to 69.50 is the support of 70. If it was the resistance level, it's 73 to 73.50 all the way to the resistance level, right? So you give yourself half a penny of operating margin, because that's really how it works. The stops are going to get run, but then the key question is, are the buyers going to come in after the stops get run? In this case, the buyers came in a little bit because, of course, the Kiwi still represents such a lucrative yield, but the yield at this point is illusionary. RBNZ clearly seems to want to take the yield away. That makes this now much more of a sell the rally kind of a trade. It's looking at this technically purely, it's come into this very, very key strong support, right? Former resistance becomes present support. It's no doubt that 70 is a very, very strong support. We may very well bounce back up to 71, but now 71 under the new dovish central bank regime really becomes a pretty decent, I think, sell the rally story. So anywhere into this zone, if we get a bounce back, it's probably going to be a sell. The next wave move, the next wave down that can break the 69.50, after that really puts us squarely into the 69 support level, which is also a very decent support level. But then after that, the truly massive big support level is this whole 68 support level. So there is probably another 200 points of downward movement over the next month or so in the Kiwi against probably selling it into any kind of rally into the 71s. As you position yourself on the side of the central banks, which is what I keep trying to tell you. So it's very interesting. We don't have that much data. We have, I think, just trade data out of New Zealand, not really much on the data set. As far as the COM dollar universe goes, it's Australian inflation data that is going to be very critical for us to look at as far as the fundamental flow. As far as the levels go, just to review those, 70 remains sort of a quasi-decent support in the Kiwi, but now it becomes a sell the rally towards the 71s, with ultimately possibly targeting 69s. With dollar CAD, the breakout to 132s really makes it a very, very powerful move to the upside that could potentially move towards the 135s. And with the Aussie, of course, it's just teetering on the edge of support here. 74 is the first level of support that it really needs to hold. And if that gets broken, if the CPI breaks the 74 support, then it really comes down all the way out to 73s as the next major level of support. Wish you guys the best of luck, the best of trading. Boris, over and out.